Good afternoon, everyone. I'm Chris Slusher from Derivative Path, and I'm delighted to welcome you to our virtual roundtable discussion this afternoon, LIBOR transition for financial institutions. With only 9 months to go before LIBOR is phased out next June, we know this is a top-of-mind issue for many of our clients, and judging by the interest we've gotten from registrants for this webinar this afternoon, we believe that it's an important issue for all of you. The industry has made tremendous strides in planning for LIBOR transition over the past 2 years, but now we are moving from the planning phase to the doing phase. And as you'll hear from the panelists this afternoon, there is a tremendous amount of work to be done over the remaining 193 days till June 30th when LIBOR phases out. We've assembled a great panel for you this afternoon of peers that are going to share some strategies that we believe will help make the transition to the new index as smooth as possible for you. I want to give each of the panelists an opportunity to introduce themselves, share a bit about their institution and their role. So I'm going to start with Mr. Hartman. Dave, would you like to kick it off?
Thanks, Chris. You hear me okay?
We can.
All right, great. This is Dave Hartman, calling in from Chicago at US Bank, and I'm on our interest rate derivatives desk. I have a relationship, I think, with a lot of the participants on the call today. So I'll be here to speak from a swap dealer perspective, as well as share some insights from what US Bank is doing as well on our own loan and back-to-back swap program as well with those clients.
Thanks, Dave. Next up, Ryan, would you care to do the same?
Yeah, sure. I'm Ryan Hinker. I'm the Director of Credit Administration and Loan Operations at Bank Iowa. We're a $1.8 billion community bank headquartered in Des Moines.
Okay, thanks, Ryan. Jeff?
Hi, good afternoon, everyone. This is Jeff Smith. I am with Veritex Community Bank. We're about a $11.5 billion bank based in Dallas, Texas. For me personally, I've been working in the derivatives market, primarily focused on middle market kind of clients for about 27 years, and have worked for several of the largest financial institutions, and look forward to the opportunity to speak with y'all today, and appreciate Derivative Path inviting me.
Thank you, Jeff. And last but certainly not least, Melanie Wheeler, who is our General Counsel, Head of Compliance, and also Head of our LIBOR Transition Office. Melanie?
Yes, thanks, Chris. I'm the General Counsel, Chief Compliance Officer here at Derivative Path. I've been working on our Office of LIBOR Transition at Derivative Path since my start here in 2018. It's hard to believe that we've been focusing on LIBOR transition for this long, but I do assist both our firm and our clients with some of the regulatory and legal considerations for LIBOR transition.
Thank you so much, Melanie. And we're delighted to have all of our panelists with us and appreciate you taking the time. I know I have a bunch of questions personally for the panel, and we want to jump into that. But before I do so, just a housekeeping item. We're going to have a Q&A session, which I'll moderate at the beginning of the call, and then we're going to allow some time at the end for your questions. So I suspect that many in the audience may have questions for our panelists, so we'd encourage you to type your questions into the question box, and if time permits, we will try to address those questions during the Q&A session at the end. So please, throughout the call, if you have questions, share them with our panel. So I'd like to start off and talk a little bit about fallback. I know that many banks have spent the past 2 years trying to incorporate more robust fallback language, both in their credit facilities as well as in their swap documentation. And I'm curious for the panel, kind of what their thoughts are on relying on fallback versus trying to remediate or amend their trades prior to June 30th. So would welcome the perspective on the panel in terms of your institution's approach to that issue. Ryan, would you, yeah, Jeff or Ryan, either one, would you care to start? Yeah.
Go ahead, Jeff.
Sure, so I'll jump in on that. So we, Veritex has been working on the LIBOR transition issue, again, for at least a couple of years. And we have, I'm part of our LIBOR transition committee, and we have definitely decided that we aggressively, not aggressively, but we want to convert all of our loans and swaps in advance of the fallback date. And we would really rather prefer to not trigger any of the fallback language in any of our contracts. So we're essentially trying to get it 100% taken care of, probably by the first quarter of 2023. And I would say that really that's primarily just for operationally. We don't want to test what's going to happen when those fallbacks start to kick in, particularly given the nature of the fallbacks, whether they fall back to like an overnight SOFR or a term SOFR. There are a variety of different fallbacks in there, and I think that we've decided it'll be easier just to really highlight all of our loans that are subject to the fallback, of course, all of our swaps, and really go to each client in advance and get those taken care of.
Yeah, I would say from Bank Iowa's perspective, we also elected to convert in advance. And quite frankly, that was a function of our relatively small exposure. So our LIBOR exposure is almost strictly related to our back-to-back program. So it was feasible with the smaller number. We had just 24 loans, about 20 relationships, and about $135 million to chew through. So quite frankly, it was a reason for us to be able to reach out to our customers in a format that wasn't just business development. It was an excuse to call them and have something to talk about, which was also a positive. So, for all the other reasons that Jeff mentioned, those certainly came into play, but with such a small portfolio, it was much easier to elect to convert in advance and kind of put it behind us.
And I understand, Ryan, that you're just about done with the process at this point, is what you were telling us.
We're very close. Yes, very close.
Yeah, Ryan gets the gold star for that. Now, Dave, I suspect that your portfolio at US Bank's a lot larger. What has been your posture, as a larger bank with a lot of loans and swaps to move over?
Sure. Yeah. Institutionally, our loan groups, our lending groups have hired a team of consultants to come in on the legal side and start reworking all of our loan agreements. I think it's a lot easier to drive the bus on the loan side than it is just from the swap side. So they're attempting to connect with everybody and redo all the loans before the June 30, 23 fallback date. Obviously, it's a little bit of a different situation when there's a loan and a swap. There's more cooks in the kitchen when we involve the swap. So, but I think to date, they're through about 10% of our swapped loans have been amended from my commercial and corporate derivative counterparts in the derivative group. So 10% of those loans that have gotten swapped have proactively been amended, and their goal is to complete them all by June of next year. Got it.
Okay, so it sounds like there's a general consensus amongst the panelists that we're trying to avoid fallback. I'd be curious from Melanie's perspective, kind of what are some of the concerns that you would have about employing fallback or relying on fallback? And then also, we did get a question about fallback SOFR, and this might be a good opportunity to address kind of the differences between the fallbacks in loan facilities versus those anticipated by the ISDA.
Sure. So let me start with sharing some color on the regulators' views regarding relying on fallback and some of the ARC recommendations for fallback. So all throughout this process, and it continues to be the case, that regulators are strongly pushing for early transition away from LIBOR-based products. So that means that they would like to see the folks who are using LIBOR-based products transition or amend those products before LIBOR cessation. So their view is relying on fallback is certainly a mechanism that can be utilized, but they strongly encourage, if you have the opportunity to do so, to amend away from using LIBOR in your products ahead of the LIBOR cessation. And, there are a number of regulatory or legal considerations, as well as operational considerations, particularly when you are running a matched program with loans that are then hedged with derivatives. Depending on the type of fallback language that you have in loans, it could vary from the fallback that is implemented in derivatives transactions. So you need to make sure that the fallback language in both instruments can act in concert so that they can both transition at the same time with the same mechanics. Otherwise, if you have a different fallback mechanism in your cash product or your loan product, and it is not compatible with the ISDA fallback, then you are introducing yourself to some risk when those two items do not fall back at the same time. So you should consider that if you do have a derivatives product, it is likely both through the ISDA protocol that we went through leading up to this process and in the US legislation that was introduced to help aid with LIBOR transition, that your derivatives products, unless you have negotiated otherwise, are going to implement the ISDA fallback mechanism, which is going to be a fallback rate that is published by Bloomberg, and they refer to it as the all-in fallback rate. And it is comprised of overnight SOFR compounded over the relevant tenor with a 2-day backward shift. And then a fixed spread adjustment is added to that. And again, that spread adjustment is set but dependent on the tenor. So you have that compounded daily SOFR plus the spread adjustment to comprise your all-in fallback rate. And that is going to be your fallback mechanism for your derivative product. Now, hopefully your loan language will be flexible enough to allow you to implement those same mechanics when you're falling back to the loan. If your loan does not have sufficient fallback language, then per the US legislation that was passed recently for LIBOR transition, it is likely to automatically fall back to term SOFR. So that's one of those instances where if you're not acting in concert, you could potentially have a mismatch. So you want to be mindful what's in your documentation to address that.
Okay. Thank you very much, Melanie. I'm curious about for Jeff and Ryan, what you've chosen as your successor index. What are you planning to amend your trades and loans to take the place of LIBOR?
I can go ahead and start with that one. So because we did start so early in the process, there were a number of indices that were still kind of competing in the market to determine what was going to be the industry winner, so to speak. And so at the time, the licensing requirements were still a little opaque, and there was the licensing cost with term SOFR. So we ended up moving to 30-day average SOFR in most of our transactions. And we did that mostly because we can make that walk and talk a lot like 1-month LIBOR. There wasn't a lot of operational change there. And so really, though, since that time with licensing becoming a more clear process and not quite as cost prohibitive as what we may have been led to believe early, we are working through that process of licensing and getting CME term SOFR spun up so that way we can offer those long term. But for now, we just have selected 30-day average SOFR.
Got it. And Jeff, what are your plans at Veritex?
Sure. So at Veritex Bank, we're essentially converting 100% of our LIBOR-based swaps and loans over to the CME 1-month term SOFR, and I think that's going to be a good move for us. Although it'll be interesting to hear Dave Hartman's perspective on trading that product and how that looks going forward. So my previous financial institution that I worked for was a BSBY shop, and it was interesting to watch as they tried to convert over to BSBY, and just kind of BSBY was difficult from a trading perspective, in that it just kept widening out. The BSBY LIBOR basis continued moving kind of against the bank, and so I know they had some trading challenges with that, and I'm hopeful that we don't see anything like that on the 1-month term SOFR side. But Operationally, the 1-month term SOFR is very clean to use. It works a lot like LIBOR does. It actually has been trading fairly close to where LIBOR's been trading, and so it's been a pretty easy transition for us on the ones that we have transitioned over.
Thanks, Jeff. And Dave, I'd definitely be interested, both as U.S. Bank as a lender as well as a swap dealer, kind of what you're seeing both internally and externally in terms of benchmarks going forward.
Coincidentally, the averages are running about the same. I checked in with our treasury team up in Minneapolis, and they shared that while they don't have an explicit view or preference to lend against term SOFR, it's about 2/3 of their loan book now. I think it took a little bit of time to get up and running. So I think at the margin where it's running at a higher than a 2/3 rate for new production on term SOFR, the rest being the SOFR daily average. In an institution of our size, I think people can appreciate there's different lending groups, different software. So I think there's a number of different stakeholders and reasons why different rates have been used in different areas of the bank. But it does seem strongly in favor of term SOFR as we go forward. I think, as well as I mentioned, having a team of attorneys that are going through and redoing the loan docs. So even from a proactive amendment standpoint, it's much easier to amend from a LIBOR contract to a term SOFR contract. They act a lot more alike than does a daily resetting SOFR loan. So there's some efficiencies to be had there as well. We touching on the topic of term SOFR, how it trades. It's been a little bit frustrating from my seat. I think everyone probably knows there's restrictions around what can and can't be done in the swap dealer market with term SOFR. Swap dealers are expected to hold that risk and not allowed to have a dealer-to-dealer basis market. This is really kind of by design from the ARC in order to keep the daily compound SOFR swaps market as the true hedging market. What it's really led to, though, is a very one-sided market. Our positions are growing very fast from a swap dealer perspective. It's not yet clearable. So all those things, that's increasing our bilateral derivatives notional, which can have capital implications for the GSIBs. As those positions grow, there's a concern about hedging in the market. Should we be allowed to eventually hedge that rate risk, that basis risk? What does that look like if we sold it at one price and then everybody rushes to the market to hedge? Does it push it wider? Does that create a negative P&L impact for these swap desks? That's a big concern. We're waiting for more guidance from the ARC to see if they do loosen the reins a little bit on what can be hedged. It seems pretty unlikely that there's going to be a dealer-to-dealer basis market. But I do think that the ARC is looking at ways to introduce some natural offsets or more dealer-to-client basis trading that could exist. So, for example, one big one there would be the dealers could trade with their own treasury desks, as our treasury groups are also have huge received term SOFR positions. They'd be in a position to pay term SOFR to the swap desks, which would alleviate the position that the swaps desks are paying to clients. Right now, term SOFR is not clearable. I think there's not a lot of appetite for those trades to be bilateral between a bank's treasury group and a bank's swaps desk. But should those positions be allowed to clear, I think you'd see that kind of open the gates. That'd be a huge first step in order to alleviate some of the stress in the term SOFR market.
Got it. Thank you much, Dave. Curious about the bank's approach to spread adjustment. So when you're going to a client and adjusting a LIBOR-based loan to a SOFR-based facility, are you doing that at the same credit spread, or are you applying any sort of spread adjustment for the amendments that you plan to do or have done? And maybe I'll start with you, Ryan.
Yeah, so we ultimately elected to keep our spreads the same. simply swapping out the index then on our loan amendments, also then keeping the fixed rate equivalent the same. So because we were sacrificing a little bit of asset yield in that case, we were generating a little bit of fee income by doing those transactions. But ultimately, it really came down to making those borrower conversations a lot less confusing. To Ramon's point in his email that he sent out, it's very, very true that this has been perceived more as an administrative function than an opportunity to negotiate or anything along those lines. So it made the process much smoother on the borrower side, just to simply keep the spread the same and then solve for the adjustment through the fee income piece.
Got it. Thanks, Brian. Jeff, what are your plans at Veritex as far as the spread?
Sure. So it's interesting. I'll delineate a difference between our loans that are swapped portfolio and our floating rate loans portfolio, because we actually have over 500 floating rate loans that are tied to LIBOR that are not swapped. And so those 500 loans, so far it's been the intention to basically take an 11 basis point spread adjustment on each of those. And so if you've got a LIBOR 250 borrower, we'd really like them to be a 261 borrower. We haven't really started that conversion process yet. We have been kind of watching the spread difference between floating rate SOFR and between the 1 month term SOFR and the 1 month LIBOR. Maybe looking for an opportune time when there's about an 11 basis point differential between those to start approaching our clients. Excuse me, but on the transactions that we have that are swapped, we're basically going to effectively force the client's rate to stay fixed at the same level. So whatever their fixed rate is now, we're going to make sure that we honor that fixed rate 100% through the maturity of their existing transactions. When we go through the conversion process, we're trying to take, assuming that difference stays around in the ballpark of 10 basis points, we're trying to take about 5 or 6 basis points of that and assign it to loan spread, and the other 5 or 6 to cover our derivative execution and any fees that we incur as part of amending those swap transactions. So that's kind of the plan. But the intention of the bank is on the overall loan portfolio to implement an 11 basis point increase to each client's rate. We'll see how much pushback we get on that as we start to push that out to market.
Got it. While I've got you, Jeff, I'm just curious about what the feedback you've gotten from clients as you reach out and start to have these conversations. Have you gotten pushback, or have they generally accepted what you're proposing? On all the ones that I've done, Chris, have had swaps on them, and those have been easy because we're holding their fixed rate the same. And if the client ends up with the same fixed rate, they don't really care what the mix is between what their floating rate is and what the swap margin is. They haven't really shown concern about that. I do think that we've had a few of our loans that we've started to have those discussions on. And in some cases, for sure, we're getting a little pushback on implementing that full 11 basis point spread increase on every transaction, especially if you look back at 1 month LIBOR versus 1 month term SOFR over the last 12 months. They've really averaged about 5 basis points difference. So LIBOR has only been about 5 basis points higher than SOFR. And so, implementing a 10 or 11 basis point adjustment on those spreads actually kind of raises the net floating rate that the client would have incurred over the previous year. So it's going to be interesting to see when we kind of hit full scale on that, what the impact is, and how many of the clients really push back on that. Got it. Thanks. Ryan, interested in your perspective on that. I know you're kind of toward the end of the process, but did you get much pushback from your clients? And if so, how did you address that?
Yeah, we really didn't get a lot of pushback. Again, all of our exposure was in that back-to-back portfolio. So kind of back to Jeff's points, maintaining that fixed rate was the key. Some of our more sophisticated borrowers did have a little bit of concern about the liquidity in the market on 30-day average SOFR and how that might impact a mark-to-market event down the road. So compared to 1-month LIBOR being so liquid. And then, you know, we're talking about savvy business people, and there's always there's no free lunch adage. And so when you come to them and say, hey, we want to do something and it's not going to cost you anything and your fixed rate's going to stay the same, they can actually be a little skeptical. So we've had to cross those bridges a few times. We didn't have to sacrifice any of that little bit of fee income that we were generating or adjust any spreads or anything along those lines. But we certainly, the first conversation, I think, back to my point earlier, having multiple touch points with the borrowers, that first time you contact them, that's kind of the initial reaction. But then as you kind of work through some of the mechanics of what's happening, that kind of goes away.
Got it. No, that's very helpful. So, to this point, we've been talking primarily about uncleared trades, and I know that many of the banks that are on the phone today may have some cleared exposure as well. And I'm curious, Dave, as you kind of think about some of the challenges that a bank that might have cleared trades has as they go through this process versus the kind of bilateral framework that we've talked about so far.
Sure. Yeah, the cleared fallback, whether you're at CME or LCH, is going to be different from the bilateral fallback. So anyone on this call who's institutions larger than 10 billion in assets, you're likely in that situation where you're going to have, if you do nothing, your client trades that are bilateral will fall back per the ISDA protocol, as Melanie said, with that 2-day shift. And then if you're on the CME or the LCH for your dealer hedges, those are going to fall back both from a different timing standpoint and a different fallback rate methodology. Both the CME and the LCH have said that we're going to convert to the just the base SOFR OIS compound rate. So that will definitely create a mismatch. It's probably an oversimplification, but if you're just removing that 2-day shift from the calculation, it's in my mind, that's kind of how I'm thinking about it. It's just kind of like shifting the reset by 2 days. I know that's not exactly the math that's being done, but it is different. So that's something to think about. It's a reason to probably proactively amend and look to line things up more closely. Another factor here is that the CME is going to start converting their trades in April. April and May are the 2 dates that they've floated out there. And the LCH is going to fall back in April and May as well. So on different dates, I think both are a week after the CME. But so if that actually shortens the timeline for cleared hedges that are going to have a different fallback rate. So that's of particular concern to us as well.
Yeah, so if I may add, both of the clearinghouses are considering doing a cash compensation component for the small valuation differences between the original LIBOR contract and the new SOFR OIS contract. So that's another distinction to keep in mind. And it's also probably worth noting that if you do have cleared trades with the CME, they are suggesting beginning of the first quarter of 2023 that they are going to publish a daily indicative analysis report that will provide some information regarding the values of the replacement swaps, the cash compensation that you might be seeing, and a summary of the key economic term changes for the replacement swap. And
Thanks for that color.
Dave, do we have any color on, we have a question about clearing for term SOFR. Can you share with us a little bit of color that you can on what you've been hearing in the market about the timing for the clearing of term SOFR?
I wish I had better color. In Q1, Q2, we spoke with our FCM. I've reached out to CME Client Services a number of times. And it was okay, probably Q3 or Q4, but it was never really a firm estimate. What I think is really the big holdup right now is this lack of an observable basis market that trades. It doesn't exist. So how does the CME choose to mark that basis relative to overnight SOFR and then publish their curves? I think that valuation concern is really the biggest hurdle. I've heard, a potential solution of the CME going out and polling swap dealers on where they see and take it one step back, a term structure has developed here. So the basis that exists to trade term SOFR for 3 or 5 years is probably less than the basis for 10 years or even beyond 10 years. So that's what we're talking about, is what would that term structure look like? And it just doesn't exist in a readily observable way at this point in the market. So I think once the CME gets their arms around that, that's when I'd expect to see it clearable. I will say is all of us use MarketWire, or most of us use MarketWire to clear our trades. CME term SOFR has been added as an index in MarketWire. So I think for bilateral trades, you could confirm them in MarketWire, but it's not yet available to clear. So there's still a stop there before going all the way.
Dave, while we got you, I wanted to touch back on a topic that you and I discussed earlier in the week, and that is really kind of as an industry, how are we doing in this process? And just, it strikes me that we've got a lot of work to do between now and June 30th. And I'm curious about your perspective as a whole, how the industry is doing in terms of the transitions and the amendments, and do we have the capacity to do everything we need to do by June 30th?
Yeah, I do think we have the capacity. I think it's quite frankly, it's a lot of work. It's something it scares me a little bit. I'll say. I think to this point, I've probably converted somewhere between 2 and 3% of my client business in the FIG space, the bank coverage space. On an annual basis, I trade with about 130 or so different banks. We've not the whole portfolios, but we've traded with, I think it's 21 banks have started this process. So that's not a huge percentage of the client segment. So there is a lot of work to do. I really just encourage people to reach out and just set a plan. I think this call did a good job of setting up institutions where you have, because the conversation is very different if you have 20 trades, 100 trades, 500 trades, 10,000 trades. We're all dealing with this very differently. A package of 20 trades can be knocked out in a day. If you're talking about something in the hundreds, you probably want to talk to your coverage and really just say, hey, how do we manage this? What's a volume that's doable on a daily or weekly or monthly basis?
Yeah, and I just chime in there from Derivative Path's perspective. As we look at the inventory of LIBOR-based trades that are still in our portfolio, it's about 3 years worth of trades that we still have to transition. And so, we certainly would encourage anyone that is planning to proactively amend their trades that we get started on that process sooner rather than later, because we are concerned that the industry as a whole is going to be kind of rushing to try to get this done at the last minute, and there's a lot of trades to be amended. Ryan, curious about your approach when you guys amended your portfolio. Did you do it in batches, or what was your strategy to tackle it?
Yeah, really, it was an organized approach to try to handle small numbers along the way, knowing that we couldn't fully control customer response, right? So kind of an initial push to get our customers contacted. And then as clients responded, we knew we needed to follow up with more or less intense contact. So again, we're certainly one of those smaller players where it's a lot easier to hold lenders or portfolio managers or whoever it is that's responsible for initiating that customer contact, holding them accountable for making that happen. But that was really the key for us, was just to have an organized approach in small batches, so that way nobody was overwhelmed and we could handle that variable client response that's inevitable.
Yeah, thanks, Ryan. Curious, as we think back to the experience, kind of lessons learned, are there any things that you would share with banks that are maybe earlier in the process, that kind of experiences that maybe you would do differently or that you think would make it more smooth, going forward for banks that are just starting the process?
Yeah, I think that the first thing is to pick your index, right? Like pick a preferred index. Don't have the kitchen sink available necessarily. That certainly makes the conversations much easier. Being ready operationally, for us, our core is not as automated as some other cores are. So making sure that your core banking system can handle whatever index it is, making sure you have processes in place to keep those accurately updated. And then just setting standards for a lot of the stuff that we talked about earlier, right? So setting a standard for whether you're going to adjust margins or not, setting a standard for maintaining fixed rates or not. What are you going to do if a client comes back and asks you, hey, there is no free lunch, right? Like, how are we going to respond in those conversations? And do an analysis on that to make sure you know the economic impact of those changes. So that way you're not swimming in the dark.
Ryan, I'm not sure if you can still hear me. Thank you very much. Jeff, I'm interested if you could share any thoughts or suggestions you have.
Sure. So Veritex is in the next couple of weeks. We are holding mandatory training sessions for all relationship managers to educate them on the process of how we're going to be implementing the LIBOR to SOFR transition. I think we're gonna, the plan is from our side to work through, we've already selected the index. It will be 1 month, the CME 1 month term SOFR. And so we're gonna train all of the relationship managers on how the transition process is going to go, and then ask them, provide them with a list of all of their loans. I'm actually going to take over all of the loans that have swaps on them, and I'm going to handle those individually myself. And so I'll go through those, if not one at a time, certainly in small batches, maybe 5 at a time, and just go through and knock those out. One thing I'll say is, as we started looking at the legal documentation side of it, I don't want to use the word messy, but we have a lot of different attorneys that have prepared loan documents for us. In the last, 3 or 4 years, our bank has been as many as 3 or 4 different banks that have all come together. And so as a result of that, we have a lot of existing loans that are documented by a whole variety of different law firms. So hopefully it'll go pretty smoothly as we start to get in there. But yeah, we'll see how that plays out as we go into fourth quarter and first quarter of next year.
Thanks, Jeff. And Dave, last but not least, appreciate your perspective as a dealer. How can we make your life easier? How can we make this work better for you?
Yeah, as I mentioned before, and I'll share a couple anecdotes too from our commercial and corporate sales team on this topic. But from my perspective, let's talk and just set a plan for how we can do this. And from a cleared trade perspective, it's probably double the work if we're offsetting cleared trades and then moving to something new versus just taking an existing portfolio of bilateral swaps and then building new swaps. It's double the work when a trade is cleared, just because of the nature of how you build the cleared offsets. So I think if you're in that camp, let's factor that in as well. From our commercial and corporate sales team, the feedback from them was really, I think they were initially surprised at how little awareness there was from the client base. they even got questions, what is SOFR? Like, what are you talking about here? So I think be prepared for some of that that's out there in the market, and have to describe, why this is happening, and really go the long way around to catch people up. And then something that was a little counterintuitive, some of our more sophisticated clients, they said, well, we don't like where the market is right now, so let's wait and see if we can capitalize on this from a timing or a pricing perspective. So while, even though maybe they were well more informed, they were more inclined to wait and push it out. So I think that you're going to get different responses from the client base, and be prepared for that.
No, that's great. Thank you. Melanie, it looks like we've gotten a few questions from the web. I know we're getting short on time. Is there anything that you'd like to highlight there?
Yeah, I think most of the questions that we've received, we have answered throughout the webinar. There is one question that I don't think we've touched upon that might be appropriate for Dave, and even Chris, you at Derivative Path. Has anybody considered transition to BSBY instead of term SOFR? Why or why not?
Dave, do you want to take a first pass at that? I'm happy to address it from a Derivative Path perspective as well.
Yeah, absolutely. So there were only a handful of banks that really did anything in BSBY that I cover. And quite frankly, we had one recently tell us that they're transitioning all to 1 month term SOFR. Even one of the big GSIBs, excuse me, one of the GSIBs that was a big supporter of BSBY, I think has started to back away as well. I pulled some of the stats from the swap data repository. It's just the SDR page in Bloomberg. The BSBY swap volumes are down about 50% over the past 2 months. They kind of peaked late Q1 into early Q2, in the 150 to 180 trades per month, swaps referencing BSBY. In August and September, there were 66 and 83 trades. So those numbers are a half or a third of what they were at the peak. And I think the market in general is really in a downshift from BSBY mode right now.
And I would echo that from a Derivative Path perspective. There was definitely some enthusiasm for BSBY that we saw last year, but that has waned. And, I think in part with the influence of the regulators and the lack of liquidity in the BSBY market has led a lot of our clients to kind of consolidate around 1 month SOFR. If we look at our transaction activity year to date, about 80% of the trades that we've seen so far this year have been 1 month term SOFR, and probably another 10% different variations of SOFR. So the market does clearly seem to be consolidating around that 1 month term SOFR as the preferred benchmark. So we are at time. I know we had a few more questions, and we will follow up with those that submitted questions. We appreciate those questions, and we'll follow up with you separately on that. I want to thank our panelists for joining us this afternoon and sharing all of their knowledge and experience. I know I've learned a lot, and it's been very helpful. Also want to extend the invitation to reach out to any of our team. If you have follow-up questions or would like to discuss this further, we'd be delighted to do so. So please reach out to your contacts at Derivative Path, and we'll be happy to answer any questions that you might have about LIBOR transition. So want to thank you for your time. We will be making this webinar available as well for rebroadcast, so we will send around a link for that. Lastly, wanted to bring your attention to a research piece that we published this week that talks about moving trades to term SOFR. We'll also circulate that around for those that may have missed that. It provides a great roadmap for those that are embarking on this process. So thanks again for your time, and we appreciate you joining us this afternoon.